The GDP, it's running out of gas. There's no other way to say it. The economy is cooling. Today's number gives us more evidence of exactly that. The gross domestic product was released at 1.3%, following last quarter's 3.4, and prior to that, 4.9%. Now, this is the daily change in the Fed funds futures. And we see here that in blue, the probability of an interest rate cut, those probabilities rose in September by 3% and in November by 5%. Conversely, the probability the Federal Reserve will not cut rates during those meetings dropped by the same amount. So we do see the futures markets moving a little bit more towards the probability of an interest rate cut, not in June and July, but September, November. Here we see the probability overall of no change or an interest rate cut. In blue, probability of no interest rate change. In September, that's at 49%. A quarter point cut stands at 45%. The probability of a half a point cut in September is 50%. Now we see for the first time there's a little bit more of a chance in September that the Fed will cut rates as opposed to not cutting rates. Overall, we can see each line represents a probability the Federal Reserve will cut rates. It's been trending to the downside. Notice, by the way, in particular, the September line, that's yellow. It's been trending down. It's a little bit below, now a little bit above the 50% level. Overall, we can see, the trend is your friend. The trend's moving lower. The trend's moving lower means that the probability that the Federal Reserve is going to cut rates is also moving lower, because overall the question is, has the Federal Reserve beaten inflation? No. We're seeing bad growth numbers like today's GDP, but so far they have not tackled inflation, and that's why these lines are trending lower. It's ticking up right now because of the GDP number, but again, they still haven't fixed inflation. Let's go back to 2006 through 8. There's not a lot to dig in today's number. It really wasn't good. But let's try to put into context what this means. Well, in 2008, 2007, actually, we saw GDP levels around 2.5, 2.3%. And then all of a sudden, the beginning of 08, we dropped into negative territory, 1.7 in the downside. Well, where do we stand currently? Left-hand side, that's 07. Right-hand side, present date. Again, today's number, 1.3%. If we had to fit that 1.3% in, where does that fit? Right in between the latter part of 07 and the early part of 08. Now, that's gross domestic product. That's growth. But there's two sides of the coin. The Federal Reserve is trying to keep growth high. It doesn't look like that's going well. It's also trying to bring inflation down. By the way, tomorrow we have PCE, personal consumption expenditure, on Friday. Well, this is what it looked like in 08. We saw PCE inflation quite high. 2008, we saw levels 4.1%, 4%, and then it began to drop, eventually hitting negative territory. Notice the inflation dropped after the growth dropped. Well, this is the inflation of 08 compared to where we are now. Today's level is 2.7%. Again, Friday, we're going to get an update to this. But if we were to take today's PCE and fit it in, where does this fit in? Somewhere mid 08. So certainly not very encouraging either back then or present day right now. Now, again, the big struggle is growth versus inflation. The Fed wants growth to stay high, good GDP levels, and inflation to come down. This is the careful balance that they're trying to strike, and this is what it looked like. The Federal Reserve, their predicament that they were in 08, this is exactly what they look like. This is actually quite interesting. The blue line represents inflation, PCE. The yellow bars represent GDP. Now, this is 08. At this point where the arrow is pointing, we had 4.1% inflation marked by the PCE and a negative 2.1% growth. Notice a spread between the two, about 6 points difference between the positive 4.1 inflation and the negative 2.1 growth. And that really sparked the beginning of the financial crisis when the inflation just would not go down, but all of a sudden growth, meaning GDP, really fell apart. Well, this is what we look like now. No, remember in the past, there was around a 6 point spread. Inflation was about 6 points higher than GDP. Well, right now, we have 2.7% PCE and 1.3% GDP. So we don't have that much of a spread, about 1.4%. But certainly, notice by the way, inflation is higher than GDP. We're have a really interesting chart in just a moment. I want to show you that's going to show when that's inverted and what that means. Here's GDP minus PCE. Now, in an ideal situation, let's say we have a really strong economy, growth is going well, GDP numbers are strong, we're all making a lot of money, yet inflation is tame, prices are steady. That would be an amazing time. Well, we would want to see growth higher than PCE. And that's what we would see when these bars are pointing to the upside. So let's go back all the way to 1995 to look to see at the moment, at those moments when the economy looked the best, meaning when GDP was stronger than PCE, when there was more growth than inflation. Well, the glory days of the 1990s. These bars show us those moments when the GDP was a lot stronger than PCE. We were all making a lot of money, yet the inflation was quite low. Now, fast forward to mid '06, these lines turned negative. What happened in 2006? It wasn't in 2007. It wasn't that the growth, the GDP fell. It was just a case of prices were rising. This is what happened when inflation overtook growth, when prices started to go up a little bit more than the economy was chugging along. And that's when this turned negative. But this is a really interesting phenomenon because back then it still felt very strong. The economy still felt very good. The stock market was still very strong. But if we were to examine it closely, inflation overtook GDP. What happened in the '08 crisis, the financial crisis? Then the growth numbers really fell apart. That's when the GDP went down. It was already below inflation, PCE, but then it went down a lot more. So it's really interesting to see how first inflation overtook growth and then growth fell apart. Well, fast forward to present day. Where are we now? We had a period of time, 2021, 2022, when these numbers went vast, but to a tremendous extent to the downside. Was that because GDP was so bad? No, it was because of inflation. What we're seeing here is the massive spike in PCE that was much, much stronger than GDP. We actually had some decent GDP numbers during this period of time. It's just that inflation was so much more. Where are we now? We're back in negative territory. Just prior to that yellow square, by the way, remember we had that 4.9% GDP number. So for a brief moment, late 22, early 23, we actually saw the GDP was stronger than inflation, relatively speaking. But then that all turned. And now we see that GDP at 1.3% is below the PCE. That's at 2.7%. Will history follow suit? Will this act as a precursor to a much weaker growth numbers in the future? Let us know what you think. Now, as we continue chugging along in this week's economic calendar, the other day we spoke about the S&P Case-Shiller Home Price Index, yesterday's Fed's Beige Book, which painted quite the ominous picture about the economy. Today we had the GDP numbers, certainly nothing to celebrate. And then we have, wrapping up the week, our big numbers, the inflation numbers. And the question at the end of the day is, okay, gross domestic product is only at 1.3%. Is inflation also going to come down, or is it going to rally? We dove into the details of the Beige Book, and it revealed a couple very interesting things about how the economy is behaving right now in specific sectors. And this speaks a lot to what the Federal Reserve may be watching as well. And I think you'll find it quite interesting what we discussed here.